Welcome to Balance of Economy. Before we break down the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers. Today's briefing is a strict quantitative masterclass on tracking institutional capital. We're going to move fast. We'll start with a retail chart illusion, define CapEx as corporate conviction, map out the AI capital domino effect, hand you the exact SEC extraction playbook, and finally, look at how to manage risk when overcapacity hits. Section 1, the retail chart illusion. Let's talk about why your indicators are severely lagging reality. Look, there's this massive misconception among retail traders. They kind of think the future of an asset is written purely in its past price. You've got millions of people out there staring at 5-minute charts, RSI, MACD. Honestly, it's like trying to predict a massive storm by staring at a weather vane instead of analyzing the atmospheric pressure. The smart money, the major funds, they aren't looking at those little squiggly lines. They are laser focused on structural balance sheets and industrial cycles. As this quote perfectly captures, price action is literally just the thermal footprint of invisible institutional capital flows. It's just the exhaust trail left behind by massive deployments of money. If you want a real, quantifiable edge, you don't guess at short-term market psychology. You follow the money to where it's most honest, directly into corporate accounting before it ever hits the open market. Which brings us to Section 2. Capital expenditures, and how to track true corporate conviction. To really grasp this, we need a simple analogy to separate OpEx from CapEx. OpEx, or operating expenses, are your day-to-day costs. Think of it like paying your monthly rent or your electric bill. It's temporary. CapEx, on the other hand, is a massive, long-term, physical investment. It sits on the balance sheet under property, plant, and equipment. So if OpEx is paying that electric bill, CapEx is signing a 10-year, multi-billion-dollar contract to actually build the nuclear power plant. It's a totally different ballgame. And that's exactly why CapEx is the ultimate expression of corporate conviction. Any CEO can go on CNBC and give glowing forward guidance. Words are cheap. But when a board of directors signs off on a massive increase in CapEx, they are mathematically committing to industrial reality. We're talking steel, concrete, and silicon. You absolutely cannot fake a multi-billion-dollar irreversible infrastructure build-out. Section 3. The AI capital domino effect. Let's map out exactly how this institutional money moves. Let's look at the current artificial intelligence infrastructure boom as our case study. It triggers what we call a fundamental domino effect. When Tier 1 hyperscalers, think Microsoft or Google, launch massive projects, it's like dropping a giant boulder into a lake. It creates entirely predictable waves. The capital flows first to Tier 2, the semiconductor designers like NVIDIA. But those chips get incredibly hot, right? So the money then flows to Tier 3, the liquid cooling infrastructure. Finally, the massive power requirements push capital down to Tier 4, right into physical commodities like copper for grid expansion and uranium for baseload nuclear power. A fundamental investor doesn't wait for semiconductor stocks to hit the front page of the news. By analyzing balance sheets, they spot the spark long before the fire. When data center CapEx from big tech jumps from $100 billion to a staggering $150 billion, the future revenue for their downstream suppliers essentially becomes a mathematical certainty. Section 4. The quantitative SEC playbook. Here is exactly how you extract this data yourself. This is the exact methodology professionals use. Step 1. Identify the industry leaders. Step 2. Ignore the flashy press releases and go straight into the Edgar database to pull the 10Q or 10K filings. You actually want to ignore the income statement because that can be easily manipulated. Go directly to the statement of cash flows. Look under investing activities. That is where you will find the raw, unfiltered CapEx numbers. Once you have those numbers, you're going to calculate 3 core predictive ratios for your dashboard. First, year-over-year CapEx growth. You divide current CapEx by prior CapEx to measure if the cycle is accelerating. Second, the CapEx to revenue ratio, which assesses capital intensity. And third, supplier correlation. You compare the industry leader's CapEx against the vendor's revenue. This is how you predict that downstream cash flow we just talked about. Finally, Section 5, overcapacity and declining ROIC. It's time to shift strictly to risk management. Economic history proves that every single massive CapEx boom inevitably ends the exact same way, in an oversupply trap. So the billion-dollar question we have to ask is, how do we identify the cyclical market top before the crash actually happens? The answer lies in a fatal divergence between rising capital expenditures and falling return on invested capital, or ROIC. Imagine a car engine where you keep pouring in more and more fuel, but it produces less and less horsepower. That is declining ROIC. When capital spending hits all-time highs, but the return on every new dollar invested starts dropping, you have found the cyclical top. The money is literally losing its efficiency. Here is exactly how that overcapacity trap plays out in the real world. An industry becomes highly profitable, which triggers all the competitors to drastically increase CapEx at the same time. But because building physical infrastructure, like AI data centers or copper mines, takes years, supply stays restricted and prices stay euphorically high. The trap snaps shut when all those multi-year projects complete simultaneously. Suddenly, a massive wave of new supply floods the market, prices completely collapse, and those shiny new investments instantly turn into toxic assets. In a market this split, you're either a momentum chaser or a value protector. I'm tracking both in real time. If you want to see which side of history wins, subscribe to Balance of Economy. I'll see you in the next briefing. Stay sharp and stay informed.